What is up, everybody? Hello and welcome to the CRE News Hour. It's a weekly podcast at 3 p.m. Eastern Standard Time where we come to you live, talk about current events and everything commercial real estate. My name is Henry Eisenstein, and I'm here with my co-host, Rafael Collazo. How you doing, my friend?
Good, man. Good. Greetings from a different time zone. I'm here in Argentina still. We actually leave tomorrow. So excited to be back in the swing of things. It's been great to be over here with 87-degree weather, but, got a lot of active deals rolling. So I got to get back to reality, which is a good thing.
Now you understand why I like to live in Miami.
Yeah. Oh God. Yeah. I mean, I knew from the beginning, bro. I've lived in Puerto Rico for several years, and 80 to 90 degree weather year round. So I'm definitely used to the. Oh yeah. So yeah, man, I'm excited to get this back rolling. Again, apologize for last week. It was kind of a hectic travel day, but really excited to get back in the swing of things. So why not start on our first article?
Let's do it.
Get this pulled up.
By the way, if you guys are tuning in, make sure you drop in the comments section where you're tuning in from. And if you have any questions or comments about any of the articles that we have going on or any opinions, make sure you drop it in the chat box down below. Love to hear it. Where are we starting off here?
First article that we're sharing today is Marcus & Millichap reports a $10 million loss, shrinking number of brokers. So if you guys are familiar with the firm Marcus & Millichap, they're an investment shop. So they primarily focus on investment real estate and then also capital markets. So they place debt as well. But Marcus & Millichap reported a $10.2 million loss in the fourth quarter of this last year. And I think a big thing that they're kind of highlighting throughout this article is that since Marcus & Millichap is somewhat dissimilar to some of the larger brokerage houses like the CBREs and Colliers, who also have like a property management arm that has a little bit more consistent cash flow, they obviously are exposed to market changes a lot more acutely than some of these other firms. And so I talked a little bit about some of the things that they're doing to kind of right the ship per se. But along with the fact that they had some losses in Q4, they also had a decrease in the number of brokers that were at the firm. I'm trying to find the exact total here. I think it was like a 6% drop off, if I'm not mistaken.
It says it right here.
There you go. Yeah, so they had a 6.4% decline from 2022. I would imagine, depending on what transpires in 2024, that number may also continue to shrink. It's kind of normal to see when you go through a cyclical environment like real estate is known to do, that you do have a drop off in brokers, which in my opinion bodes well for those who remain after the cyclical event has occurred. So I would imagine that the brokers that do survive this period of downturn that was 23 and going into 24, you're going to be stronger for it. And hopefully as the transaction volume continues to increase, you're going to get a bigger piece of the pie when it comes to, the transaction volume. So just kind of talked a little bit about, the differences between some of the larger houses like the CBRE and Colliers when compared to Marcus & Millichap, mainly that they just don't really have a property management arm that can kind of stabilize them over time. So just thought I'd share this article to kind of show.
Super interesting. So leave it where it is, because it even says here, Marcus & Millichap's loss to stand in contrast to earning reports from the other big brokers. Colliers reported a slight increase in revenues in Q4, while CBRE reported revenue increases of around 9% in the fourth quarter and $477 million fourth quarter profit. So it's like when you're looking at Marcus & Millichap, which has a team of 2,000 agents, a brokerage of 2,000 agents, and if you scroll up, it's like this is what's mind-boggling to me. Marcus & Millichap has 2,000 agents, and their profit they had a quarter four loss, which is unbelievable. I don't even understand how you have that for 2,000 agents. It's ridiculous. Revenues right here. Just stay here. Marcus & Millichap posted a $10.2 million loss in the fourth quarter. The Los Angeles-based company sales brokers just closed on Friday. By contrast, the firm brought in $7.2 million in profits the same quarter the previous year. It's like, could you imagine having 2,000 agents on your team and only making $7 million in a quarter? That's ridiculous to me. I'm like, I feel like they're obviously, I don't know what the heck they're doing with their money or where they're spending all their money on. Like, clearly they should be doing like WeWork and trying to get out of some leases, because I think they're probably spending way too much money on support staff and OpEx and stuff like that. Like, there's no reason to have so much cost. Like, revenues dropped, and even says in the next paragraph, revenues dropped by 37% for the quarter, down from $262 million in Q4 for 2022 to now only $166 million in the quarter, which is in 2022 they did $262 million, which is half of the profit of CBRE in the same quarter, which is
I mean,
wild.
It's crazy. Yeah. And what's nuts to me is, I mean, and I've never been affiliated with Marcus and Millichap, so I don't claim to know their splits, but I believe their splits are still like 40 to 50%. So
they are,
regardless of what their agents are producing, they're taking, let's call it 40% just to be conservative of whatever the brokers generate. And Marcus and Millichap is kind of known as a house that is kind of a burn and churn type of environment where it's like they want people to produce at a high level. And if you do last in Marcus and Millichap, you tend to do well in the investment space. But
it's funny because Marcus and Millichap, I've had a lot of agents who come to me for coaching, and then they're like, "Yeah, my office doesn't let me use a dialer. They don't like when I cold call off of a dialer." It's like kind of funny because they're like they want them to hand dial. Like that's how old school this brokerage is. It's kind of entertaining. But look at this. I mean, it just like the fact that for the full year of 2023, the company posted a $34 million loss, which is with a 50% drop in revenue. I mean, ridiculous. The broker's deal volume was down 39%, reflecting the overall U.S. commercial sales declining by 55%. Anyways, I just think they're running it in the wrong direction. I mean, I can't imagine any brokerage like this that is honestly hurting as bad as Marcus and Millichap. It's honestly kind of shocking to see how they adjusted in 2023, clearly in the wrong ways. So I think that's an interesting piece of information to take as a commercial real estate agent. And if you're looking at other brokerages to join, be very careful with who you join, because companies like Marcus, which might have a positive sentiment about the company, the people who run the company are really important to pay attention to. And clearly they're not running it the right way.
Yeah. And also, again, it just goes to show the importance of expanding your verticals when it comes to commercial real estate, because just being in one vertical or maybe two verticals that are heavily driven on the ebbs and flows of the market can be very detrimental to consistent revenue. So, obviously having a property management arm, getting invested in real estate yourself so you can get consistent cash flows. That's going to be extremely important when you start building an enterprise like this, because otherwise you're just kind of at the mercy of the market. And obviously 2023 was a hard year for transactions, but if you had a robust portfolio on the property management side, and maybe you yourself were owned, let's call it a couple of retail centers, and you had a lot of consistent cash flow from tenants, because retail did extremely well, industrial did extremely well, you were able to weather those storms pretty well. And you may have very well had a profit as well to come out of 2023. So
Waleed was also asking, by the way, is what states are good for prospecting commercial real estate. I think that's really dependent on what you're looking for. Multiple different aspects of that question can be answered differently. Obviously you and I are working in different states. I think it really depends on what you want to focus on prospecting wise. Like if you want to do multifamily, I would probably stick in the Sun Belt. If you want to do industrial, I'd probably stick to certain specific states where you have higher demands for industrial. If you're looking for retail, you're probably going to want to be in more condensed areas. There's self-storage, more condensed areas. So it's just going to be very different for different asset classes. For industrial, you're probably going to want to look in places with incredibly high demand for industrial, which are probably going to be, big industrial, I'm trying to think of the best word. What's the hubs, industrial, transportation hubs is probably going to be where New Jersey is really heavy for industrial. Certain areas in Texas are very hot for that. California is hot for that. Florida is hot for that. Chicago is pretty hot for that. I mean, there's a lot of specific industrial hubs that I would look at. And then you see here for CBRE, what are they doing better or different? At least in my opinion, I think they are one of the largest owners of real estate in the country. CBRE tends to buy a lot of real estate, and like you had mentioned before, they have a property management management department. So property management and owning real estate will allow you to kind of stay alive during downturns, because you have the cash flows. Plus the fact that they also have, I think, 100,000 brokers nationally or internationally. Which is, what is that, 50 times the amount of brokers that are at Marcus and Millichap. That kind of helps. And I'm sure their splits are probably a little bit more competitive. So that means the house is probably taking in a little bit more. Other than that, I don't know if you have any takes on some of the things that you do.
No, I agree with you. I think that's the way it is. I think the biggest reason why some of these other bigger brokerages were able to kind of do okay in 23 is because they had those exact verticals. So they had the property management arm. They had, several of these brokerages, like you said, of investment funds that they own these properties in. And obviously that's more consistent cash flow. And if you're concentrated in industrial and retail, they did phenomenal in 23. So again, That's why I believe if you're going to build a business around real estate, it's important to kind of explore multiple different verticals and not just pigeonhole yourself into one vertical, but to each their own, as they say.
Yeah, absolutely. So
All
what do we
right.
got
So
here?
next up is one of Henry's articles. It says retail tenants stay put amid dwindling space options.
Yeah, so this is kind of just, I'm going to actually bring this up a little bit bigger on my screen. This is just talking about how shopping centers, the occupancy rates are holding strong, which is kind of interesting across. I mean, obviously, this is national data. Obviously, you need to do your research for your local markets. But this is just interesting where it's like, I believe that retail, this is for move outs, right? Like how many people are vacating their spots, right? Their spaces. So it's just going to show that, like, there's been a lot of people who are just kind of staying where they're at, right? Which is, allowing for occupancy rates to rise, vacancy rates to decrease. So, retail in most markets, it shows, at least nationally, are actually doing fairly well. I'm actually working on getting into contract on a retail building right now in New Jersey. We negotiated a pretty good deal with that, and it's interesting to show where it's a pretty interesting time to get into retail, like strip centers, especially in major markets. I think there's a lot of optimism when it comes to retail, which there was not for quite some time, obviously through COVID, and I think it finally is coming back. So pretty excited to get back into the retail space. A lot more people are getting a little bit more active in that area. I don't know if you have any insights. I know that you do a lot of retail.
Yeah, that's what I do a lot of. Yeah, I'm actually working on a pretty decent sized shopping center deal right now here in Louisville. So yeah, I'm very bullish on retail, and obviously you've got different verticals of retail that people sometimes don't understand or don't think about. Obviously you got the big power centers, the regional centers that have been kind of what people have perceived to be the anchor, or the way that generally retail is perceived. But then you have, what we were talking about, which we're bullish on, is the neighborhood, like the small neighborhood shopping centers, or, even some single tenant lease property, depending on, if you're able to get it at a good price. And, if the financials of the firm on site and the viability of the lease is good, then obviously you can structure a pretty solid deal if you have the capital to be able to do it. So again, I'm pretty bullish on retail for that exact reason. And again, consumer spending is still pretty strong. I mean, even though, as we've mentioned on many occasions, we do believe we are in a recession, so that's probably going to taper off within the next year or two. But I still think there's going to be a strong demand for retail, regardless of where you're located. But again, it's very specific to the area you're located in. So just get a very good understanding of where the top retail corridors are in your market and what type of retail you're going to be targeting, because you don't want to just paint retail with a broad brush and then buy something that maybe isn't a good location, or is it maybe it's functionally obsolete, or whatever that may be. So just do your homework.
Yeah, it was funny. So I was working. I had somebody who's been watching my content for a while. They reached out. We talked for a little bit. They're looking at buying this property. And they said they're going to look to buy it cash. I told them to speak with my mortgage guy, who I do a lot of investing with. And my mortgage guy was like, I wouldn't have my banks, my lenders, touch this with a 10-foot pole. I was like, I wouldn't go anywhere near this property. And I was like, that's pretty good sign to say you probably shouldn't buy it if the banks are running. So it's like, a really good thing, like, for any of these types of retail buildings or any building that you're looking at for investment purposes, is just talk to a commercial lender and get their, gauge their level of interest in the deal. Like, how badly do they want to try to lend on the deal? And if they're adamant about trying to get the loan on this deal, they're obviously pretty excited and think it's a good a good investment. But if they're running for the hills and they think it's, it doesn't pencil in any fashion, they don't even want to lend on it, that's probably a great indicator to say that it's probably not a good time to, or not a good deal to invest in.
Yeah, no, 100%. And again, lenders are very risk averse. So if they are really clamoring for the deal, you've got something that's pretty solid. So
yes, absolutely.
I couldn't agree more with what you have to say. All right, we're getting a lot of comments, so we appreciate your guys' engagement. We'll go ahead and continue to pull up other articles for us to kind of go through.
So.
All right. So next article is a huge multiplier. Advanced augmented reality comes to CRE. So I'm sure you've seen commercials for the new AI virtual reality technology that Apple's producing.
The Vision Pro.
It's really, really cool. I haven't personally messed around with it, but I've seen a lot of tutorials on YouTube, and it seems like it's a really interesting technology. So they kind of talked about some of the applications potentially of utilizing these VR technologies. As of right now, virtual tours and 3D imagery has become somewhat commonplace in commercial real estate, in particular since COVID, just because there was a period of time where people couldn't go on site to be able to view these buildings. And so there was kind of a rapid adoption of that technology early on. But nowadays, they're starting to kind of incorporate new applications, particularly when it comes to design. So they kind of talk a little bit about how some of these firms had like reconfigured how they were going to lay out a space based on how they generated it within a VR environment. And then, they essentially changed their architecture plans to kind of meet their new optimal layout. They also talked a little bit about how you, especially when you're trying to get land entitlements with different cities, oftentimes you'll provide them with like a site plan and renderings and elevations, which are static in nature. But when you incorporate potentially VR technology, now you can create a fully functional building that looks, real, and you can kind of showcase at these different meetings and say, hey, look, this is the type of structure that we're planning to put on site. These are all the different nuances and details that we've already kind of thought through. So it creates a compelling reason for you to achieve whatever rezone that you're trying to accomplish. And so, or get the approval you need to from the right people in the different areas that you're trying to target. And so they were just kind of incorporating some of these or talking about some of these applications through this article. I think it's phenomenal, and I'm really excited to try to incorporate more and more technology into my business, and over time, hopefully, it's going to pay big dividends. So, I don't know what your thoughts are.
Yeah, I think this is really interesting. I think that we all know that this is probably where things are going, where there's going to be a lot more, especially for development purposes, a lot more augmented reality in regards to kind of, rendering purposes, right? Like showing renderings and giving the world an idea of what is going to be built. However, I do believe that, this is probably a few years away. I'd imagine that, it's not like for the average real estate agent. I don't think there's much that we can really say that this is going to change in the near-ish future. But definitely over the next couple of years, I think it's something to definitely play around with. I think that if you have the right connections, like the old paper renderings that we were getting, where they would give you like a PDF document which kind of has some renderings. I really do believe that the next 3, 5, 10 years or something like that, we're going to start seeing some augmented reality where you'll actually be able to walk the building virtually and prior to it being constructed. So I definitely am really excited to see how this goes. I just don't, like for right now, I think, as different softwares come out, as different technology comes out, I think it's just being open to playing around with it, right? Just being open-minded to the idea that it will not always be the same. And the people who play around with different softwares, who learn the different softwares, who are open to AI, who are open to all these different kind of augmented reality options and learn the game. I'm not saying implement it in everything you do, but I do believe that understanding the game, how it works, so that you're not like shocked all of a sudden, where like all of a sudden things are transitioned, where I think that you should be up to date with everything that's out and just learning to play around with certain things. I think it'll be really supportive for your business personally. So I'm playing around with a bunch of, AI programs and different softwares, and definitely trying to see where it can be implemented and things can be delegated. But I think over the next few years, we'll really see a drastic change.
Yeah, 100%. And obviously, depending on the vertical that you operate in, from a brokerage standpoint, if you deal a lot in the tenant space, for example, a lot of times you're dealing with tenant fit out. So if you have a dark shell space that they haven't built out at all, you can literally put on these glasses and organize or coordinate with an architect or a construction person and try to create the space kind of live for the potential tenant. Now, I've seen some technologies I went to the CRE Tech conference a few years ago. It's kind of a national conference for technology in the commercial real estate space in particular. And there's some really cool technologies that they kind of showcased. One being a drone technology that you can kind of bring the drone up and hover over a parcel of land. And these developers, obviously, a lot of these larger entities and firms have kind of templates that they follow as far as how the building layout and everything else. And so it allowed you to kind of go vertical on a parcel, map it out, and then flip through templates for these different people. So it'll be like hotels, or, if you're working with Chick-fil-A or you're working with McDonald's or some of these other places, you could literally go vertical, lay out the plot, and then flip through all these templates. So from a site selection standpoint, it made it a lot quicker than it would if you had to go through all the nitty gritty, other things that you would have to do in order to confirm whether or not a site would work or not. So it just creates the speed of decision making. It helps shrink the gap. And so if you have an understanding of how this technology works, it may not apply to you today, but you'd be surprised if in your business, if you continually learn about what's going on in the space, what type of things you can do.
Yeah, 100%.
We're getting a lot of engagement. That's great, man. We're getting a lot of people providing commentary, which is great.
Yeah, let's see. What lead saying, all right, thanks. Multiple streams for property management. So that is not a result of the production of the realtors. I mean, it's definitely a both and, right? I think that there's definitely a value of the realtors producing and the training and other things, as well as the other verticals for income. Naseem says your content is quality full, also very good. Thank you. Lead says, what is the difference between shopping malls in the heart of a city and ones further out, meaning in terms of corporate or cap rate, sorry, in terms of cap rates? If you want to go with that, I'll add in after.
Yeah, it depends. I can't speak for every market because every market's going to be slightly different. But, obviously when you're talking about properties because retail values it's all based on the function of sales. So if you can achieve a high amount of sales on site, then obviously you're going to be able to pay more as far as rent is concerned. And so typically in more densely populated areas where the potential for sales is higher, you're going to obviously be able to generate more income on site. And in theory, you should potentially have a lower cap rate. But again, it depends on the property, because you could also be in an area of town that's maybe not a good fit for retail. Maybe it's a very densely populated area, but for whatever reason, it just doesn't support the type of retail that you're trying to have on site. And then maybe it doesn't trade at the same cap rate as a property that maybe further down the street would trade at that cap rate. So
exactly,
it's not a one size fits all answer, unfortunately.
Yeah, but no, I think you explained it right. I think that, the more densely populated areas in the Class A locations versus the Class D or C locations, like they're obviously going to trade at lower cap rates. There's more demand to be in those locations. It's like, think about it in the terms of, take Miami, to be in downtown Miami where everyone and their mother is walking around, driving around, or not, I wouldn't say driving, God forbid, but a lot of activity. Like here in South Beach, so many people are active in a bunch of different, main drags. People are going to pay a crazy price per square foot. Like they're as high as like over $100 per square foot for retail. And then you have, obviously secondary, tertiary markets where you're going to be so far off the beaten path where no one really drives ever. You're going to have a much lower price per square foot that people are going to pay. And the cap rates are going to be much, much, much higher because, there's going to be a lot less demand in those locations. So, yeah, I agree with everything you said. So what do we got here?
All right, next up is one of Henry's articles. It states, multifamily construction timeline hits record 25-month high. That's great. Good to hear.
So, this is saying construction timelines have gotten to the point where from start to finish that they're taking longer. Is the way I'm reading this, where it's like saying the timeline now, timeline for multifamily development now between 2 and 2.5 years. So at least from what I'm understanding, the way I'm reading this is saying that it's interesting how, to me, I mean, this is between construction delays, right? Like the supply chain has become infinitely more complex, even more costly. There's a lot more regulation. There's a lot more hoops for developers to walk through. And it's just interesting. Like this article just kind of stood out to me because there's a lot of people who talk about getting into the development world. And I think, like, I have a deal right now that I'm in contract as a broker on a development deal. And it's about 120,000 square feet, give or take, maybe 130,000 square feet of industrial. It's 2 parcels. And it's interesting to me for, like, so many people are trying to get into like land development as a broker. which kind of is mind-boggling to me because this will be probably one of the longest sales cycles of any deal I've ever worked on. And it's like, the commission on this deal is over $400,000. I mean, it's great and all, but the fact that you have to wait 12 or 24 months to get a check is something that I'm so curious why people spend so much time, energy, and effort trying to target. I just think that there's a lot better things that people can be targeting, like, again, like currently existing product that I think you can make plenty of money on and you can close on fast. And this is just goes to show that the time horizons for these types of projects are taking a long time, and it's just going up, especially with supply chain issues. So I just really think that, this is, it's a very interesting kind of asset class for people to get involved in. And, maybe curious to get your thoughts on where they should probably be spending their time.
Yeah, no, I mean, I think it is a niche type of vertical, and we're undertaking our first development here in Louisville. We're under contract to rezone the property, and they'll be closed and do ground up construction on a particular parcel. And we put it under contract last year in June. We'll probably close in May, and then we'll do demo shortly thereafter. And then that's another 9 to 12 months to erect the structure. So that's a 2-year timeline for the development plan. So you have to have a pretty good staying power. And, and again, I'm not an expert developer, so I'm sure there's those individuals who are on the call right now or watching this in the future that have a lot of adult experience could probably comment better than I, but it does seem to be more of a long-term type of play. I mean, it's not one of those things where you're going to see the things bear fruit immediately, but hopefully over time, if you take on a project here, a project there, a project there, a project there, those are the ways that these big developers have kind of built their quote unquote empire. So, I think it's good to try to get into the game, but understand it's going to take a long time. And depending on the size of the development, it's going to be very capital intensive. So you're probably going to either have to come up with a lot of money or raise some money. And that's kind of what we've been doing, is raising some capital to get the deal done. So,
yeah. And it's like, more so just talking specifically for those agents who are looking for a check right now. I think land development will be probably the longest turnaround for people to collect a check.
Easily, yeah.
So it's just, I believe sticking with an existing product will be something interesting. And obviously, if you're trying to get into the game of getting into the game of development, like you had mentioned, Raphael, where, it's like, it's definitely a staying power game, and you need to have, you have to raise a lot of, there's a lot of capital involved in the whole process. So it's just, if you can raise a lot of money, I think, and you can find good deals where you're going to get land cheap and you have the ability to build a lot of product on top, and for a good price, I think you're going to do very, very well, or can do very, very well. And just need to really dot your I's and cross your T's when you do your underwriting.
Yeah. And maintain a strong cash position, because if the economy turns, that's how a lot of people lost their shirt in 2008 and some other cyclical times in commercial real estate. So,
Exactly.
Again, just understand what you got. I mean, it's interesting to see. Obviously, we got a significant drop off of multifamily starts. So I think I misinterpreted the article when I first read it. I thought it was like a good thing that, we've seen an uptick in construction timelines, but you're right. It's taking longer to construct the product, and there's a lot less starts happening in the space. So it doesn't necessarily bode well for development in that space, but maybe existing product now becomes a lot more attractive. So if you can,
That's for sure.
Yeah. So, all right. So
What do we got next?
I know we're about to ruffle some feathers. All right. Let's see what we got here. All right. So next up is Supreme Court denies challenge to New York's rent regulation law. So so essentially what this article kind of highlighted is, I don't know if you guys are familiar with what's happening in a lot of places around the country, but in particular, I guess in New York, there's pretty strict rent stabilization laws that were kind of put in place in the late 1960s, and they've been slowly amended over time. And it does put a lot of pressure on landlords to be able to keep up with just inflation. Obviously the cost of everything has gone up, yet you can only raise, I think, rents by like 3%. I think it's like 3% a year.
Yeah, approved rent increase. There you go.
Yeah. And of the existing housing stock, which I had no idea in New York, apparently 44% of the rentable apartment units in New York are rent stabilized. So
Yeah,
I
right.
had
Scroll
no
down.
idea. Yeah,
I
is it
think it
right
says
here?
it right there. Yeah.
Yeah. So there are a little over 1 million rent stabilized units in New York, representing 28% of the city's overall housing stock, but 44% of its rental units. So, I mean, that's crazy. I had no idea that was the case. Along with that, among rent stabilized units, the median monthly rent is $1,400, which again is less than half of the average for New York City. So
Generally applies to the units in the buildings before 1974 with 6 or more units. Got it. Generally applies to buildings of 6 or more units. That's insanity.
yeah, I mean it's unbelievable. I mean, in Louisville, Kentucky, for a 3-bed, 1-bath, I'm getting like 1,100 or 1,200 a month, and it's like an older. It's not not a high end unit by any stretch of the imagination. If you were to have like a nicer high end unit, you're talking 15 to 1,600. So you're telling me that in New York City, for a apartment unit, the average is 1,400 a month. I mean, that's crazy considering the amount of demand that probably exists in that city. So, they talked a little bit about how the initial lawsuit was filed, or the hearing. I guess they wanted the local municipality to hear the case. They kind of shot it down, and they've been slowly elevating it up to the different judicial levels until it reached the Supreme Court.
So if we just talk about this openly, I am so against rent control. I'm so against it. And regardless of being a landlord, it's just like, look, and I'm a tenant. I rent this place that I'm in right now, right? And I've been a tenant, right? Like, I like to own investment properties, and I like to rent where I live. I think that it's an absolute ridiculous statement for us to believe that rent control is a good thing, because you are only hurting the entire economic cycle, right?
Mm-hmm.
It's like now now the landlord has absolutely no incentive to invest in the building, right? If you look at all the buildings in New York, you will see beaten up properties that look like they're not being taken care of, properties that have been not updated or touched in decades, specifically because they have no incentive to do so, right? So it's like you are just causing a crazy economic cycle that is only disincentivizing landlords to keep up to date with their properties. And listen, it's like, why do you actually want people who are struggling to afford to pay rent in these markets? Because it only inhibits the ability for the entire city to grow, right? In my opinion, I think it's a really silly thing where it's like, listen, gentrification, which is the improvement of a specific city where the buildings are being redeveloped into specific types of quality units, where you're going to attract a higher quality of individual to move into a location which will pay a higher level of rent, and the individuals who cannot afford it will slowly be moved out to other secondary and tertiary markets. This has been occurring forever, right? In every asset class, by the way. This has been occurring in every asset class. And for them to take New York City, which, I mean, like, nonetheless, all the BS that's going on with Trump right now, with him getting the crazy indictment, the ruling of the $350 or $400 million lawsuit for New York. New York in itself is an absolute trash state. It's a loser state, and the way they're running it in every regard, politically, financially, capitalistically, I mean, it's just absolutely ridiculous how the entirety of the state is being run. And I don't care. I don't know what anybody can possibly say that's positive about New York City. And by the way, I lived in New Jersey. I love New York for food, great food, and awesome shopping. But to live, it is absolutely ridiculous to say that living in New York is a positive thing, especially with this kind of BS here. So it's kind of insane.
Yeah, and regardless of the political side of things, I think more so what oftentimes people fail to understand is that, the best way to help bring down the cost of living is to provide more supply. And so by restricting the amount of rent that can actually be charged, you're affecting that supply. So the demand's still going to be there. I mean, there's plenty of people out there that need to rent space, but because there's less and less stock available, the existing inventory that is obviously rent stabilized is no longer going to be of high quality. And again, like you said, if I'm going to be barely surviving as a landlord to keep this building alive because I can't raise the rents, and the cost to operate the building goes up 10, 15% a year, especially over the last several years, it's like, what's the point? Like there's no reason for me to be able to incentivize me to kind of put back in the building. So all the existing stock is starting to diminish and essentially become worse.
Yep.
So again,
Exactly.
I think it's just a failure to understand that economic principle causes issues. So, but
absolutely,
I do like New York City. I don't know if I'd live there long term by any means, but I do like the vibrancy of the city. It really is.
I'm telling you, listen, for a nice weekend, like I was just up there a few weeks ago, huge fan. I could do a couple days up in the city, but to live there, I just think to deal with all the politics and all of the nonsense that's there, I just think it's ridiculous.
Yeah, and Miami's pretty nice. So
hard to beat Miami.
You did a good thing. All right, so New York again. Let's see it. All right, so New York City apartment vacancy rate recorded at historic low.
Yeah, I mean, you were just talking about this. Like the demand is insane to get for housing, and the fact that they have all these ridiculous rent control laws, which you get the top right there, right? It says here, the data is clear. The demand to live in our city is far outpacing the ability to build housing. Of course it is, because of exactly what we just talked about, right? The New Yorkers need our help, and they need it now. But you're making it more difficult, Mayor Adams. Thank you very much. In 2021, the last time the city conducted the survey, the vacancy rate was more than 4.5%, a difference of 310 basis points in the latest measure. Apartments priced between $1,650 and $2,399 had a rate of just 0.79 vacancy rate. It's insanity. 99.25 occupancy, while the rate of units between 1,100 and 1,649 was 0.91. Of course it is. Of course it is. And obviously the more expensive units have a little bit higher of a vacancy rate. No, obviously. But this just goes to show, of course, the very, very cheap apartments, the cheapest apartments in New York City have almost a 0% vacancy rate, because who on planet Earth wouldn't rent an apartment for $1,500 in Manhattan?
Yeah. Yeah, I mean, and again, it kind of goes to show, like, obviously the new stock. So what often ends up happening, because obviously the cost of construction and a lot of other expenses, input costs have gone up. The only developments right now that make sense are the newer developments. With newer developments, you're going to have higher rents that are charged on site. But what people fail to understand is, yeah, that new building may be, whatever that rent amount is, but that means that more supply occurs. So there's going to be more people that move into that building, and then there's going to be rents that are spaces that free up in other buildings, which will help bring the rent total down for a lot of residents. And so, again, it's just kind of reinforcing this idea that what needs to happen is you need to allow more building, because if you allow more building, it's going to help ease some of the cost associated with living in the space, because then vacancy rates increase. Now you start getting a more of a tenant-friendly type of landscape, and then rents will come down because landlords will want to attract the right tenants to their space, and they'll offer concessions, maybe the lower rents, et cetera. Yeah. You saw it kind of during COVID when kind of everyone vacated from New York for a period of time. The rent levels, that's what, yeah, they all came to Jersey. They all went to Florida, and now you had like their vacancy rate was unbelievable. And I had friends that lived there that were able to negotiate like, $500 or $600 off their rent, and they signed like a 2-year lease. And that's all because the demand went away.
Yeah, exactly. Very, very smart. It's funny. It's like, and it's interesting because I feel like it helps so many other aspects when you can allow the increases to be above the CPI, because it's like now the secondary and tertiary markets are also going to see massive increases in value in those properties. And for a lot of the newer investors who can afford secondary and tertiary markets and they can't afford to be in the primary markets, you're going to be able to make a lot of great money, right? And like, think about it. If you're a property owner where you own an investment property like Raphael, myself, it's like, in your taxes and your insurance and the cost of management and the cost of all these other things are increasing by substantially more than CPI, more than the 2, 3, 4% or whatever, right, percent per year. And you're only able to increase your rents by 3%. That means your expenses are growing at a faster rate than your income, and you're going to eventually have a major problem, right? So it's like, and then what becomes the actual point of owning investment properties? It's like, this is why I'm a huge fan of investing in areas with absolutely zero rent control. I just don't want to deal with it.
Yeah. And luckily on the commercial side, they tend to not have as strict rent control. There's no real rent control laws for businesses. So if you do invest in commercial real estate, typically you don't have to worry about that. And that's kind of one of the other reasons why I'd prefer, commercial investment versus. Yeah, exactly. Because, businesses, you would expect them to be able to, again, it's just part of the game in business. You can either pay or you can't pay. So, all right. So next up is debt restructuring options for CRE owners. The reason I wanted to share this is because it kind of gives us an opportunity to get educated on the ways that we can structure deals so that we can potentially either capitalize on those deals ourselves, or, if you're looking to list property or represent owners, you can provide them with solutions that ultimately help build trust with you. And then ultimately you can potentially help them sell their property. So just kind of talked a little bit about some of the restructuring options for debt and different ways to, kind of navigate this current environment that we're in. Obviously the debt moratorium, consolidation, settlement, debt equity swap. So these are just terminologies that are utilized in the lending space to describe, these things. So, sometimes if you have good standing with lenders, you can kind of approach them and try to get, it's either a suspension or reduction of payments for a period of time, just to kind of help you weather, either if you had a vacancy for a tenant that's kind of enabled you to go below the debt service coverage ratio for that particular loan, then obviously you can approach your lender and hopefully be able to navigate these murky waters so that you can get out the other side in a positive way. Obviously, equity infusion, just putting more money into the deal, can help, alleviate some of the burden that debt causes. Sale related transactions, obviously that's kind of where we could step in potentially as agents to help them do that, or potentially do a sale and lease back, which I know Henry's talked about a lot on this interview and podcast, I should say. And I've worked on some sale and leaseback deals in the past. I haven't been able to get one done as of yet, but it can be a very powerful tool in your tool belt. And then it talks a little bit about, rent restructuring. Unfortunately, if you have to, you definitely don't want to, but if you really need to, Chapter 11 bankruptcy filings can help you restructure debt and start getting out from under some of the creditors that ultimately are seeking to, secure the asset. So again, there's just different things that you can potentially share with your potential clients, or, you yourself should also understand, because again, if you're in the real estate game, knowing all the different options that you have at your disposal when things happen like this can be pretty powerful. So that's
great article.
Yeah.
I think that this is, I feel like everyone should take an hour a week and really get to learn a lot of these different concepts and terms, really understanding this terminology, because when you can understand this better than your competition, you are going to create, without a shadow of a doubt, way more opportunities for sales as a broker and even as an investor than most, right? Like really understanding these concepts is going to open up entire percentages of opportunity in your market, because there's a lot of people who go, hey, I have debt coming due and I don't want to sell. Well, guess what? You can learn how to do. You can learn how to restructure, their debt, get paid on debt financing. Which is completely legal on the commercial side. So it's like learning all of these different ways of supporting clientele is really going to be really supportive, especially like the leaseback stuff. I've done a number of them. Really lucrative opportunity where someone has debt coming due. They're going to not lose the building, but they're all of a sudden going to have drastically higher expenses, where they rather just sell, capitalize on the gain, and then just lease back the building like they were already doing for themselves. So anyways, just a lot of really interesting stuff. Great article here.
Yeah, no, definitely. I thought it would be helpful. And again, I think the more educated you get on the business, and this is exactly why we do what we do on these live streams, is try to educate you guys about, number one, live events, that things are happening in the commercial real estate space, so you keep up to date, and hopefully you gain some good nuggets out of it as well, as far as, strategies that you can pursue in your own business. So, all right. So next up is fundraising by real estate's biggest investors hit 11-year low. So this is Blackstone.
Yeah. So I wanted to bring up this article. This is just to show you that as much as articles like this keep coming out, what I have found is that there's still tens of billions of dollars, if not hundreds of billions of dollars, being raised And it's like people, these types of articles come out on national TV, on the news, and they try to, come across as like there's this huge issue. Guys, 2023 had the highest interest rates that we've seen in the last decade, like clearly, or even longer than the last decade. Last 10, 20 or 20-ish years or more, right? Even I guess since the 80s, it's the highest interest rates we've seen in a long time. And it's like, of course, there's going to be a lot less money being pumped into deals over the last 12 months. Going into 2024, as they see interest rates coming down, I think there's a lot of money. Everyone that I talk to who are big time investors, I can't even explain it. Literally all of them are like, I have so much cash sitting on the sidelines just waiting.
Mm-hmm.
So much money is waiting on the sidelines for great opportunities. So just be cognizant when you see articles like this, because it's like I think that actually I don't know if you saw Blackstone to come out with this, but they were talking about purchasing back their stock. Like they're so adamant about what they're about to be doing, and what's on the time horizon that they're saying that they should be buying. They're going to be buying back a lot of their stock. So listen, guys, huge opportunity for 2024 and the years to come. I'm optimistic. A lot of these companies, by the way, even though they're saying that they've raised a lot less money, are buying a freaking ton of property right now, and it's about finding them great opportunities.
Yeah, 100%. And the floodgates will open in the near future. I mean, that's why like you said, you've got a lot of people out there that have a lot of money on the sidelines, and they're just waiting. And at some point, that dam's going to burst. And so I think, like you said, obviously when you see like a Blackstone just not raise as much capital, I think what it is they probably already have a lot of capital at their disposal that's just waiting to place. And you don't want to ever let your money just sit there for a long period of time. And so I think they're just being preemptive about that.
And plus, it was 11% down from the year prior, when the last 2 years was the highest ever recorded in money being funded. So it's like we're still not actually in a bad place. We're still higher than we were pre-COVID.
Yeah. No, yeah, I couldn't agree more. All right. So next up is office and retail can find value in teaming up. So, this article just kind of highlights the feasibility of some retail tenants occupying certain office buildings, but primarily on the first floor. And so I'll even speak to a potential listing that we're going to be having like here in Louisville, where I'm going to be working with a gentleman who owns an office building downtown that has like 12,000 square foot of vacancy on a floor plate. And the downstairs is a lobby, but there's a section of that lobby that's like 500 to call it 800 square feet that he wants to attract like a coffee shop or a bakery or some sort of retail tenant on site to be able to kind of build the ambiance so that, people are always stopping in, moving in and out and everything, to kind of create that vibrancy within the building so it becomes a little more attractive place for people to potentially want to locate their business on site. And so, again, that's the type of ideal scenario that a lot of these building owners are trying to achieve, is they're trying to create a retail kind of anchor, not necessarily even an anchor, but a retail component to their building that creates somewhat of a vibrancy and it becomes an amenity for the properties such that they can attract additional tenants to the property. And so again, that was kind of the highlight of the article. I don't know if you've seen that anyway in your market, or maybe you've seen it kind of trending in one direction or another.
Yeah, I think it's an interesting opportunity to just talk with townships in your local markets to understand like who's flexible and who's not on the zoning, and say like, hey, there's these office buildings that are 50% occupied. Would you be open to the idea of converting the first floor to retail with front exposed windows, right? And kind of reconfiguring the structures a little bit, where you actually have a little bit more of a prettier facade, where instead of it just being completely gray, right? Which a lot of these office buildings are gray, and then windows and gray, and the windows, where you actually have the ability to like transform the entire downstairs into just like prettier exterior exposed space for retail. Not only do I think that you can capture occupancy percentages, I think you can capture higher percentage or higher rental prices. I think you can capture the office tenancy that are looking for, a little bit of live work kind of concepts, right? Where not specifically living, but like, a little bit more friendlier exterior spaces where they can have the coffee shops. They have the other types of businesses downstairs, like virtual golf and all that kind of stuff, which makes it more entertaining and more fun to be upstairs working. So anyways, definitely a cool point. And I think that for the right office facility or right office buildings or right locations in different areas. I think this could be really, really interesting to see.
Yeah, and obviously here I'm in Argentina right now here, and it's unbelievable to be on a coffee shops that are on like all these different corners and different areas, and then they'll have, it's a mixed use property. They'll have some other component, either office or residential or whatever upstairs. So it does make it does make sense to utilize that space more efficiently, and obviously for some retail users, it could be a great spot for them to locate. And so,
Absolutely,
I think
because a lot of those upstairs are fantastic locations.
Oh, absolutely, yeah. All right, so the last article is Children's Place seeks new funding after reporting loss.
Yeah, so every single time you see articles like this, you should be going on Google, type in the Children's Place in your local area.
Yeah.
Figure out what retail centers that they're in and find the property owners and give them a call. Because guys, stop it right here. It's saying the Sea Caucus, New Jersey-based retailer with more than 500 stores issued the warning Friday when it reported a preliminary unaudited result for the fiscal fourth quarter last year, where it fell below expectations. Net sales, goes on and on to basically say that they're going to be closing a bunch of stores. This is an opportunity, people. Like if you have a tenant if you have specifically the Children's Place as a local business in your market, there is a decent probability that they might be closing in the foreseeable future. And I think it's important to note that this is just an example. I'm not saying they are going to be closing your local Children's Place, but I am saying that when you see articles like this, where you see large big box retailers or large retailers in general closing locations, it is important to look up on Google where they located, call those property owners, because there's going to be some of them which we're told that, hey, I'm gonna try to see here. This is a perfect price here. The Children's Place over the past few years has slashed its store footprint in half, looking to shift more into its online sales. At one point, it had more than 1,100 retail locations. In November, the company reported at the end of the fiscal third quarter, it was down to 591 stores. Ridiculous, right? So, guys, this is an opportunity to constantly be on the lookout where they are in your local areas. Call up the property owners. They may have been told that they're leaving, and especially if they're the anchor tenant, they're going to be in trouble financially. So it's important to just pay attention that this could be a good opportunity for you to pick up a listing or a sale in some capacity.
Yeah, 100%. And there's two retailers on this list that I've done that too, where I've contacted the owners, both Bed Bath & Beyond and Tuesday Morning. I've done that several times here in Louisville, and it works, man. I mean, they really, you read the news, sometimes, I haven't had this happen, but I'm sure in some instances you can even kind of deliver the news to them, because they may not even be in direct communication with their tenant.
Within this article, last year there was a bevy of retailers whose woes, just like you had said before, led them to seeking additional funding, file for Chapter 11 protection, and actually liquidate. Bed Bath & Beyond, Bye Bye Baby Chains, Tuesday Morning, Christmas Tree Shops, Party City, and David's Bridal. Like, if you have these types of businesses in your local markets, that's a fantastic opportunity for you to be reaching out to these property owners, send them articles like this, and you're actually going to be doing them a service where you say, like, hey, I might actually have an investor who might be interested in buying your building, even given the current situation.
Absolutely. No, great advice, man. Really. All right. So that's it for today as far as the articles are concerned. If you guys have any other questions in particular, feel free to type away in the chat box. We'd be happy to answer any ones that you have. Along with that, if you guys have any deals that you're actively searching for, or you have that you want us to review online, we're happy to do so. Just feel free to reach out to us. Send us an email at deals@thecrenewshour.com with the subject line deal, and then obviously your property address, so we know what you're looking at. We'll try to see if we can maybe go live and kind of walk through it and see if we can give you guys some feedback. So,
love it. Awesome, man. Well, this is a great session. Again, thank you guys for tuning in. Any last minute comments or concerns, my friend?
Nothing, man. It was good seeing you all as always. Really excited to continue this on, and excited for next week.
Yeah, let's do it. All right. Great job, guys.
All right.
Take care.
See you guys.